Hello everyone, today with MarketXLS we're going to talk about the covered call option strategy. MarketXLS is one of the top Excel-based investment research solution for investors. In this video we'll be discussing what a covered call strategy is, how it works, and how it is calculated using MarketXLS. So without any further ado, let's start with the topic. A covered call is best implemented when you expect the underlying security to go up moderately in the near term. A covered call strategy is a limited profit and an unlimited risk strategy. So what we do in this strategy is that we go long on 100 shares of an underlying security and go short on one out-of-the-money call option of the same underlying security. MarketXLS offers a template for this strategy. Here's an introduction page and here's an active template. The yellow cells have to be inputted by the user, so the stock ticker and expiry date. Some upcoming expiry dates are available for reference on the side. For the purpose of this video, we'll be using Microsoft expiry date as 23rd July. We've sold one out of the money $280 call option contracts of Microsoft and hence we'll receive the premium. MarketXLS has many templates just like the covered call one you see here, and it refreshes all the data when you click on Refresh All. A payoff schedule and a payoff diagram are available in the template too. They can be used to analyze the maximum gain, loss, and break-even. Maximum gain for the covered call is limited and is achieved when the stock price, so the price of the underlying, is greater than or equal to the strike price of the short call as shown by the green box. In addition to the premium received for writing the call, the out-of-the-money covered call strategy's profit also includes a paper gain if the underlying stock price rises, up to the strike price of the call option sold. Maximum loss is unlimited and occurs when the price of the underlying security falls below the purchase of the underlying, as shown by the red box. However, this risk is no different from that which the typical stock owner is exposed to. In fact, the covered call writer's loss is cushioned slightly by the premiums received for writing the calls. Break-even point for the covered call can be calculated using the formula break-even point equals purchase price of the underlying stock minus the premium received. That is all for today. If you want to read more about this topic, please visit the MarketXLS website, which has hundreds of blogs and templates. If you want to get in contact with us, please book a demo and we'll be happy to help.